Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss investing during all-time highs. Specifically, I'm going to chat about why all-time highs make investors nervous, what nearly 100 years of market history tells us, why properly built portfolios don't react to headlines, why retirees should focus on their financial plan, not yesterday's market headline, and lastly, as always, a few action items for you to consider. A consistent theme these days I hear from clients is, Michael, the market is at an all-time high. Should I wait before investing? Or, should we be doing something different until things settle down? And it's an understandable concern. When we hear the phrase record high, many people automatically assume a correction must be right around the corner. After all, what goes up must come down, right? Well, not exactly. Let's start with why this question feels so logical. We're conditioned to think in physical terms. You throw a ball in the air and it eventually falls. You stretch a rubber band and it will snap back. So naturally, many investors assume markets work the same way. If stocks have gone up too much, surely they're due to come back down. The financial media certainly doesn't help with this. Whenever markets reach new highs, you'll often see headlines suggesting stocks are defying gravity or asking whether we've reached the top. If your social media algorithm is anything like mine, you may see more doomsday predictions, charts and graphs with cherry-picked data, or some guru telling you he knows exactly what stocks you should be buying or selling. Those headlines and social media posts attract attention because fear sells. Fear clings to us much more so than optimism. And when the business or person on the other side of that post offers a warm blanket to help soothe this fear, many get wrapped up in the message, which in the long run could have tremendous consequences. But markets aren't governed by the laws of physics or by your emotions or some random YouTuber with 100,000 followers. They're driven by business. When you own a diversified stock portfolio, you own thousands of companies around the world. Every day, those businesses are trying to sell stuff, create new services, become more efficient, generate higher profits, and in turn, rewarding you, the shareholder, over time. The value of those businesses naturally changes as expectations change. And over long periods of time, profitable businesses have tended to become more valuable, which means new market highs aren't unusual. They're actually to be expected. Here's a statistic that surprised me the first time that I heard it. Looking back to 1926, the US stock market reached a new weekly all-time high 933 different weeks. That's roughly 1 out of every 6 weeks over almost a century. So think about that. If record highs were rare warning signs, they certainly wouldn't occur that often. In fact, the opposite is true. Healthy markets spend a surprising amount of time making new highs because over long periods, businesses tend to grow. Now, here's the part that matters most. Many investors assume buying at a record high automatically leads to poor returns. The historical evidence says otherwise. One study, which can be found in the show notes to the episode, looked at every monthly market close between 1926 and 2022. Roughly 30% of those monthly observations occurred at new all-time highs. Researchers then asked a simple question: how did investors do if they invested after those highs? And the results were remarkably ordinary. 1 year later, 3 years later, even 5 years later, returns were almost identical to investing during any other month. In other words, buying at a record high wasn't a disadvantage. Here's another interesting statistic. Historically, the market finished higher 1 year after reaching a new high approximately 81% of the time. 5 years later, it was higher roughly 86% of the time. Now, does this guarantee future returns? And of course not. Markets can fall tomorrow or even next month. They can even experience significant, sometimes violent corrections. That's simply the price we pay for earning higher long-term expected returns. But history does not tell us something important. A record high, by itself, has never been a reliable signal that investors should get out. This is where retirees often face the biggest challenge. When you're still working, market declines can actually be beneficial. You're continuing to save and invest, meaning you're buying more of that investment at a lower price. Retirement is different. Now you're relying on your portfolio to generate income. So seeing markets at record highs creates a temptation to protect what you've built. The problem is, if you move everything to cash or fixed income or even gold, waiting for a correction, you now have to answer two questions correctly. When do you sell? And just as importantly, when do you get back in? Most investors spend all their energy trying to answer the first question. Very few appreciate how difficult the second one is. I've seen this firsthand with clients over the years. Someone sells because they're convinced markets have gone too high. Then the market keeps climbing. Now they're waiting for the correction. Months go by, sometimes years. Eventually, markets are even higher than when they sold. Now they're afraid to buy back in because prices seem even more expensive, so they continue waiting. Ironically, trying to avoid one correction often leads investors to miss years of positive returns. One of my favorite observations from this research is stocks don't need to rest. They don't become tired after reaching new highs. They don't know where you bought them. They don't know where they traded yesterday. Today's price simply reflects what millions of investors collectively believe companies are worth based on future earnings, not past prices. Now, does that mean valuations don't matter? Not at all. Valuations absolutely matter. Paying a reasonable price for future earnings is an important part of investing. But that's very different from saying the market hit a record yesterday, therefore I should sell today. Those are two completely different ideas. This also reinforces why diversification matters. Rarely does every part of the market reach record highs simultaneously. So while US large cap stocks may be leading, international stocks could be lagging. Value companies may be priced differently than growth companies, and small companies often move differently than large companies. That's why we build diversified portfolios. We're not trying to predict which area wins next year. We're building portfolios that can participate wherever future return shows up. Now let's bring this back to retirement planning. When someone asks, is now a good time to invest? Interestingly, I think that is actually the wrong question. The better question is, does this investment strategy support my retirement plan? Because retirement isn't about maximizing returns this year. It's about creating dependable income over the next 25 or 30 years. And that requires an investment strategy built around your spending needs, your tax strategy, your withdrawals, and your ability to stay invested during periods of uncertainty. If your portfolio is appropriately designed, an all-time high shouldn't change your plan, just like a bear market shouldn't completely derail it either. One of the biggest advantages of having a written retirement plan is that it removes emotion from decision making. When markets are soaring, the plan keeps you from being overly optimistic. When markets are falling, the same plan keeps you from becoming overly pessimistic. Your retirement shouldn't depend on guessing where markets go next month. It should depend on following a disciplined process over decades. I'll leave you with one final thought. If stock markets are expected to produce positive returns over the long run, then new highs shouldn't surprise us. In fact, we should expect them. Not every week, not every month, but regularly over time. Because if businesses continue innovating, growing profits, and creating shareholder value, new highs are simply evidence that capitalism continues doing what it's done for generations. The goal isn't to avoid investing at record highs. The goal is to avoid letting emotions convince you to abandon a sound long-term plan. Because in retirement, confidence doesn't come from predicting markets. It comes from having a financial plan that's designed to work through whatever markets happen to do next. All right, so that'll do it for today. Here are your action items for today's episode. First off, if you have a major purchase or a lump sum need that you're going to need cash for in the very near future, it's always important to have those funds available. A properly structured, goals-based investment strategy should factor in these short-term needs, ongoing cash flow requirements, and the need to outpace inflation over the long run. While the goal over a 30-plus year retirement is to stay invested, it's always prudent to make investment decisions based on your goals, not the markets. Lastly, don't get suckered into the next market fear vortex, especially if you are retired and now living off of your investments. A properly structured retirement plan will give you the confidence to tune out the headlines and focus on what matters most, enjoying each and every day, living out your retirement purpose. All right, so that'll do it for today's episode. Make sure you add us to all of our socials. For the links and resources mentioned, check out the show notes or visit retiringcanada.ca. If you're enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure you're signed up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.